Hi everyone, and welcome to the Plato Mid-Reporting Season Update. My name is Darcy Graham, and I'm Associate Director at Pinnacle. I'm joined today by Peter Gardner, Portfolio Manager for the Plato Australian Shares Income Fund. Today we're going to be taking through a 10-minute update on reporting season so far. It's certainly been an interesting round of reporting so far with some large moves. Pete, I'll hand it straight to you. Can you take us through a few relevant stocks that have reported and how Plato are viewing the results?
No problems, Darcy. Yep, so the first one I'll take you through today is Commonwealth Bank, which announced last week. It was a good result from Commonwealth Bank. Their profit was just over $10 billion, so $10.2 billion, which was up 6% on last year. But it was actually down 3% on the first half when you look at just the second half result. And that's because their margins look to have peaked, at least for the kind of shorter term. I think we pointed this out last time. So they actually increased their dividend significantly though, which was good. It was up 14% to 240 cents versus 210 cents last year. And that equates to a 6.5% annual gross yield. So it's a pretty solid result from CBA. They've actually been increasing their payout ratio recently, which could be as a result of off-market buybacks being off the table, that they now are using this as a way to distribute their franking credits. So I've been increasing their dividends. As I mentioned, the margin did slightly reduce from the first half. So it went down from 2.1% to 2.05%. But given their confidence in their kind of margins and also their capital ratios being strong, they announced a buyback of $1 billion, which is positive. Now their bad debts are maintaining their low levels, and while they have announced that their home loan arrears, so that's the people that kind of have stopped paying off their mortgage for the time being, have increased in June, they're still at very low levels to what they are historically, and the balances in the offset accounts actually are up 6.6%. And that was particularly true of some of the older demographic, where they announced kind of they're doing a bit better in this environment than some of the younger people. So overall, it was a good result from CBA. They're still getting a lot of their deposit funding from their deposits, and so that's positive, that even though interest rates kind of are going up, they're not having to tap the market as much as they did kind of a few years before. So overall, it was a good result from CBA. Now moving straight into the miners, Rio Tinto announced its result a couple of weeks ago, and it was a decent result from Rio Tinto. Their underlying earnings were down 34% on last year, and that's largely because the iron ore price had fallen significantly last year. Now it was around what they produced in the first half this year. Iron ore price has rallied a little bit from its lows, but it still was well below what it was last year, and that would cause the reduction in underlying earnings. Now, their dividend also got reduced the same amount, so down 34% on last year, but you can see how large their annual gross yield is at 8.2%. So even though they're paying out 50% of their earnings, they've got an 8.2% annual yield. So they are actually very cheap in the current environment. And if we do see stimulus coming out of China, then that could mean Rio Tinto are in for a good time coming up. They've also got some growth prospects coming up, and that's largely why they're only paying out 50% in terms of their payout ratio, that they've got a Mongolian copper project that's just started producing in this half. And then they've also got a New Guinea iron ore project that's not so good for Australia because it's not iron ore coming out of Australia, but it's good for Rio Tinto. So solid result from the miners, solid result from the bank. Where reporting season was pretty strong compared with expectations was in some of the retailers. And we saw this in JB Hi-Fi, where FY23 sales were up 4.3%, which is 35% above pre-COVID levels. Their earnings were flat on last year, but that is 120% above pre-COVID levels, and it was 4% above expectations. So obviously everyone in the market's been forecasting that sales have been coming off for the retailers, but at the moment some of the retailers, not all of them, but some of them are maintaining very strong results. We also saw a very strong result from Super Retail Group yesterday, whose sales are maintaining their kind of high levels. Now, we did see a reduction in the final dividend from JB Hi-Fi of 25%, but it is still a 9.6% annual gross yield, and it's paying out 65%. So again, you can see how cheap JB Hi-Fi is, that people aren't expecting these high level of earnings to continue going forward. But when you looked at their July like-for-like sales, you actually saw, while it slowed a little bit from the first half of FY23, it was actually JB Hi-Fi Australia was down just 1.8%. JB Hi-Fi New Zealand was actually up 10%. because they didn't have such a big boost in July last year. But the area that was struggling for JB Hi-Fi was the Good Guys, which obviously sells a lot of those kind of home appliances that, as you've seen, the reduction in the kind of housing market, you're actually seeing slow down in that area. And so retailers that are more exposed to that area, we expect their sales to drop significantly more than JB Hi-Fi's. So overall, a good result for JB Hi-Fi and a bunch of the other retailers as well. The last stock I'll take you through is Telstra. It was a solid result from Telstra. Their earnings were up 10% on last year, and they guided for earnings up around 5% next year. So a fairly solid result from Telstra in the current market environment. They've got an 5.8% annual gross yield, and so for a defensive stock like Telstra, that's pretty decent, given it should be pretty protected in any kind of economic downturn. And their mobile services revenue was up 8.3%. But the one thing that I think was the reason their stock was actually down on the day when they announced yesterday was that they announced that they were keeping ownership of their InfraCo, which they'd set up. So they'd set up a separate company which owned their infrastructure assets, and they had been hoping to monetize that to sell it off to the market at a much higher multiple because it's viewed as kind of lower risk. But they've decided, and management announced, that in the current kind of AI environment, where there's potentially greater demand for some of that infrastructure, that they thought they could monetize it better in-house. But I think the market didn't necessarily agree with that. They would have preferred to get the money up front. And so we saw a slight reduction in Telstra. So that kind of gives you a bit of a flavour for how report season is going so far. Overall, it's been pretty solid. There's been a couple of companies that have disappointed in terms of their guidance, particularly with regards to interest costs being higher. Now, that should have been something the market should have been able to forecast, given interest rates have clearly gone up. But that's been an area of a bit of disappointment in the market. But overall, it's been pretty solid so far.
Fantastic. Thanks, Pete. Appreciate it, and appreciate your time today. Now, to everyone who's watched the video, be sure to look out for another video that we'll do as a post-reporting season update. We'll take a look at another set of stocks, and Peter will take you through what the Plato team are seeing. For more information on the Plato Australian Shares Income Fund, please reach out to your respective Pinnacle BDM, and we appreciate you taking the time to watch the video. Thank you.